Good evening, everyone. Can I please ask for you to settle down, grab your seat, and we're just a few seconds away from starting, so. So welcome to Bloomberg's first India Credit Forum. We're here this evening to do two things. First and most important thing, please pick up your phones. Please, indulge me, pick up your phones, point them to the QR code on your table. It will give you access to subscribe to two of Bloomberg's finest newsletters. One of them I author, and I highly recommend. It's India Edition. It's a weekly newsletter on the fastest growing major economy in the world. So please sign up. And the other I'm a big fan of. It's The Brink. It chronicles corporate distress, bankruptcies, and turnaround stories. Fascinating newsletter published twice a week, and I urge you to sign up for both of them. All right, let's get on to the main draw. What will it take to fund India's journey as it aspires to become the third largest economy by the end of the decade and a developed nation by 2047? Now, a goal that's 2 decades out seems romantic, wishful thinking, but time is powerful. Just look at how far we've come in just 10 years. I looked up a 2014 speech by then RBI Governor Raghuram Rajan, and he was talking, of course, at that point in time about a crippling bad loan crisis and the need for more technology adoption across financial services. Now, that was the year, 2014, when the Bharat Bill Payment Service launched. And yes, in 2014, an automated bill payment service was a big thing. Today, 10 years later, we're one of the world's most advanced digital payment services in UPI, which, for those of you who are not familiar with it, is an instant real-time payment system for interbank transactions through mobile phones, and it has revolutionized payments. Soon, a unified lending interface that aggregates creditor information and cuts loan appraisal time could possibly do the same for the credit market. As for asset quality, bank balance sheets, as all of you already know, are amongst the healthiest ever. And RBI, now under Governor Shaktikanta, is policing credit quality before it can become a systemic problem. Even the corporate bond market is finally showing promise. Fresh fundraising is set for a second straight record year of over $100 billion. So a $5 or $7 trillion economy may seem far away, but the conversation on the credit market that we need to support it needs to start now, and that's what we hope to do this afternoon with all of you credit market experts and India's top regulators. Please join me in welcoming to the stage Shaktikanta Das, Governor of the Reserve Bank of India. In his 6 years at RBI, Governor Das has used conventional, unconventional, and sometimes innovative policy measures to preserve financial stability while mitigating the impact of threats ranging from a once-in-a-lifetime pandemic to everyday inflation. Governor Das will be in conversation with Reto Gregory, Deputy Editor-in-Chief of Bloomberg News. Reto, it's over to you.
Thank you so much. Governor, thank you so much for joining us. It's an honor to have you here at our first India Credit Forum. I'm sure everyone here will want to hear your views on the latest inflation print and the outlook for interest rates, and we'll get to that in a moment. But first, I'd like to step back a little. Everyone is talking about India these days. You just overtook China as the world's most populous country. Economic growth is also outpacing China's. Indian bonds are being added to international indexes for the first time, and local equity markets have been going gangbusters. Some call it India's moment. Others say it's now the world's most crowded trade. Some even say there might be an India bubble. In view, how would you describe it? Is it India's moment? Is it a crowded trade or a bubble?
Well, thank you for inviting me, and thank you to all of you. I have been participating in Bloomberg events. I participated, I think, one event some 4 or 5 years ago. Am I audible to the audience? Yeah, okay. So I heard part of what Menka mentioned. I think she has said all the good things about RBI and what all we have done. But I think if I am right, I heard her mentioning that also policing the credit market. Now, we are not policemen. We are watching very closely. We maintain vigil over the credit markets. And when there is a moment when it becomes necessary, we take action. But coming to your point, I think I would broadly agree that this is India's moment, because India's growth story is intact. Inflation has now come very much within the target range. It is expected to moderate, but there are risks. In fact, there are significant risks, and we are very careful in monitoring the overall outlook with regard to both growth and inflation. And the balance between growth and inflation is well poised. So far as the credit market is concerned, the bank's overall financial parameters, the performance indicators of the banks in financial terms are very robust, and deposit growth was a bit of a problem. That is the gap between credit growth and deposit growth. But now the gap between the two has been considerably narrowed. And so banking sector is doing well. The other source of credit which has emerged in the recent years is the non-banking finance companies. Now, non-banking finance companies roughly occupy about 30% or so, about 1/3 of their asset size is their loan books. Their portfolio is about 30% or 1/3 of the books of the banks. So that is one sector which is emerging. Within NBFCs, we have also a special category of non-bank finance companies called ICCs, that is investment credit company, infrastructure investment and credit companies. So that also is showing good progress. And then we have other, other instrumentalities, other mediums like the REITs and the InvITs, and of late the alternative investment funds. So multiple track now funds are available to the, for the credit market in India. I'm not talking so much about the retail credit. I'm talking about the credit for the overall broader economy. And also then there is, of course, the foreign investment, which is coming both through the FPI route, the foreign portfolio investment route, as well as the other routes like the external commercial borrowings, etc., which have shown good progress in the recent years.
I mean, Prime Minister Modi has set a goal for India to be a developed country by 2047. To achieve that, gross domestic product would have to grow more than sixfold, which seems like an incredibly tall order in less than 25 years. In your mind, what should India focus on to get there? Is it infrastructure? Is it job creation? Is it tackling inequality? Is it even opening financial markets further, or a combination of all?
I think it has to be a combination of all. In fact, in India, there has been considerable amount of discussion in the public space, whether it should be, a manufacturing-driven growth or a service sector-led growth, or whether it should be led by this or that. But I think for a large economy like India, for a large population like India, it has to be, we have to follow multiple approaches. It has to be, on multi-sectoral growth, which has to happen. And overall, the size of the GDP is growing, and the investment, the overall domestic investment has remained around 30% or so over the years. But in gross terms, in absolute terms, it is obviously, there is more investment happening. And 2 or 3 areas which I would like to emphasize is, I think the first is manufacture. First is, the infrastructure sector. On infrastructure, good progress has been made in the recent years. And I think government is giving considerable amount of emphasis on infrastructure development, not just on large infrastructure projects, but also on rural infrastructure projects, which is very essential, especially for the large cross-section of Indian people who depend on agriculture. So rural infrastructure would include basically roads, provision of electricity, then access to agricultural markets by transport network. So infrastructure and also the port network is improving. Airports, there have been significant progress over the last few years. So physical infrastructure, there has been considerable amount of improvement.
I mean, the World Bank says that India would need something like $840 billion through 2037 just for the urban infrastructure. The government obviously is going to pay for a lot of that, but what's the role of the private sector and how can you attract more private sector money?
I'll just come to private sector. Before that, just one sentence on infrastructure. It's not physical infrastructure, but I think it is also the digital infrastructure where India has made excellent progress over the last few years. And then, of course, if you treat human capital as a part of the broad infrastructure which supports the economic growth, there is considerable amount of emphasis on skilling, reskilling, etc. Now, I'm not getting into the number about how many billion US dollars are required for India's growth, but again, India has to sort of tap the domestic resources through multiple routes. As I mentioned, the non-banking finance companies, banking sector, yes. Then there are certain all India financial institutions which are now specifically focused on infrastructure sector. Then we have to, of course, use these REITs, InvITs, and considerable amount of opening has been done so far as the foreign investment in India is concerned. And we need to also tap in a lot into the foreign capital. That is something which is happening. On the external commercial borrowing route, for example, the Reserve Bank, 3-4 years ago, we have liberalized and opened up the, that particular channel for accessing funds from the foreign markets, commercial borrowings from the foreign markets. So through multiple sources, it is happening. There are important issues to be addressed in opening up further issues in the sense that, we have in our interactions with foreign portfolio investors or foreign direct investors, we do they do point out what are the impediments and what are the challenges they are facing. And we try to address those issues in consultation with our other regulators in the financial markets, like the securities market regulator, for instance.
What's the biggest complaint you're hearing from foreign investors?
I think there are some complaints about KYC related issues, know your customer related issues, and knowing the ultimate, the beneficial ownership of investments. Now, this is not something which is our creation, but this is a FATF requirement. This is a FATF requirement, and rightly so, given the context of today's world where there are money can come from many sources. One has to be very careful about which sources, the sources from where money is coming, who are the beneficial owners. So it's in compliance with the FATF requirements. Naturally, there are KYC related issues. So there we get often representations about issues relating to procedural issues relating to know your customer, that is the KYC related issues. And that is being addressed not just by us, but also by the securities market regulator. Particularly for foreign portfolio investors, it's more to do with the securities market regulator, the Sebi, which is dealing with it.
Which we'll hear from Sebi in a moment. On the bond market, Menaka mentioned it's growing. But still, the corporate bond market is still only about 16% of GDP, which is lower than in other big economies. Are there any policy steps that India should consider to expand that particular market?
You see, bond market, quite right, it has grown over the last, I would say in the last decade or so. It used to be about the annual fundraising through the bond market was in the order of about 3.7 trillion rupees or so per, the annual bond raising of resources through bonds. Now, the latest, last year, it was about 8.6 or 8.7 trillion Indian rupees. So it has considerably increased. We have taken, the Reserve Bank has taken a few steps in the recent years. For example, there is a partial credit enhancement the Reserve Bank has facilitated. Then we have now permitted, the corporate bonds also to be treated as a part of the part of the HTM holding of the banks. We have recognized that. So like that, number of steps have been taken. And for major projects, there is a requirement. We have mandated that 50% of the resources should be accessed ideally from the bond market. So we have taken number of resources. But it's a work in progress. We have to there are issues to be addressed. We have to be taking more number of measures. First thing is that, the number of institutions which are participating in the bond market, it's mainly the banks, the insurance companies, the mutual funds, and the pension funds, or the provident funds as we call them. So we need more of institutional investors to come in. This is again one area where the foreign investors can come in. There is a certain cap provided, considering the prudential. There are prudential caps, that is ceilings prescribed for that, but it has not been utilized. Only 15% of the total space which is available for foreign investors to invest into the Indian bond market, only 15% of that has been utilized. So there is considerable scope to access the foreign funding, that is foreign investors into the corporate bond market.
So how do you
and
get the
finally,
other 85%?
just one more point. Finally, I think we also need to focus on, and we are focusing on, developing a robust secondary market for corporate bonds. I think that is something which we are working on, and that's something which will, I think, add a lot of momentum to the corporate bond market. Sorry, yeah.
Private credit is the buzzword at the moment. Everyone is trying to get into private credit. What's your 30,000-foot view on this new asset class that everyone is trying to get into? Good thing, bad thing?
You see, at the global level, I think private credit is increasingly becoming, it is posing certain risks, and I think every central bank or every regulator should be looking into that. Private credit, the quality of credit appraisal or the quality of collateral, there are certain underlying risks. I'm now talking about at the global level. And the resilience of private credit in a downward credit cycle, or when the economy is entering into a more challenging phase, when the economy is entering into a more stressed period, the robustness and the resilience of private credit is yet to be tested. So therefore, there is need to undertake stress testing of private credit in multiple stress, hypothetical stress situations. Now, so far as India is concerned, it's not a problem at the moment, in the sense that private credit in the Indian context is mostly offered by the non-banking financial companies, which are regulated by the Reserve Bank. And 3 years ago, we have completely recast the regulatory architecture for the non-bank financial companies. We have a scale-based regulation now. Depending on the size and complexity, the regulatory requirements and the norms are, stringent, depending on your size and complexity. And if it's a small entity, not very complex, a local level entity, then the regulatory requirements are rather benign. So therefore, it is quite a well-regulated sector. In India, at the moment, we don't see any problem. One area we saw some risks building up, some potential risks coming up, and that has been addressed already, is the alternative investment funds, the AIFs, the structure of AIFs. We noticed some discrepancies, some deviation from the norms, and we saw some risks building up. So that has already been addressed. We noticed it in time, and on a proactive and a preemptive basis, we have, prescribed regulatory. We have prescribed regulatory instructions in that regard. So that is by and large well contained and well managed. So far as India is concerned, I think private credit has a lot of distance to cover. It has to grow. But at the moment, we don't see the kind of risk which we see at a global scale. I mean, at a global scale, meaning in the rest of the world.
Currencies, the rupee has stayed relatively stable compared with its peers. From you, there's been a big push to build up foreign exchange reserves over the years. You've accumulated more than $300 billion during your term in office. Do you feel there's a need to continue to add to the reserves, or are you done?
No, we have no specific target so far as building up of reserves is concerned. You see, I'll tell you from where we are coming. We saw, not long ago in 2013, India experienced, like many other economies, the taper tantrum. And taper tantrum, eventually nothing happened, but just, a couple of statements were made. And the kind of volatility it created in the forex market with regard to the capital flows. I was at that time in the finance ministry in the government. So I have seen the kind of volatility the markets witnessed and the kind of stress with which the Reserve Bank the challenges which the Reserve Bank of India had to deal with. Now, we cannot have a repeat of that situation. India is growing, the size of the economy is growing, and there are we cannot be depending always on global safety nets. In today's world, I think each country has to build up its own safety net. So we are coming from that background. In that background, we have been, whenever there is an opportunity, whenever the market offers an opportunity, we are building up reserves. And they have now crossed 700 billion, the figure which will be released later today in about an hour's time. It has come below $700 billion. That is mainly because of, the revaluation, some amount of valuation losses in the securities and in the currency losses, etc. But that's not much, and we'll again go back to 700. So we have no such target. Whenever there is an opportunity, we are building up reserves, and I think a large economy like India must build its own resilience, must build its own buffer, must build its own capacity to withstand, the capital flows. If forex is coming in, if capital is coming in when the cycle reverses, it can go out with equal, in equal size and speed. And we should be prepared to deal with that kind of situation where capital flow causes a problem. And with regard to the currency, the Indian currency has remained pretty stable, is the least volatile. But one point which I think I would like to share here is that if you look at on a, let's say, 2.5 year horizon, if you look at from the beginning of 2022, and the Ukraine war started in February 2022, and inflation went up, and the tightening cycle started from March, April onwards of 2022. So from January 2022 till now, the rupee depreciation vis-a-vis the dollar is about 11.5%. The dollar has appreciated during this period by about 8 or 8.5%. So rupee has been depreciating in response to the overall movement of the dollar and the overall movement of the international market. So it's not as if, why I felt it necessary to clarify, because sometimes there is an impression that, and I'm not being defensive about it, sometimes there is an impression as if we are managing the exchange rate. We are not managing the exchange rate. Rupee is depreciating overall, vis-a-vis the dollar, and we buy the dollars whenever there is an opportunity. And when there is a dollar shortage in the market, we supply dollars to the market.
I mean, history shows, if you look at Japan many decades ago, or China, more recently, if you have accelerating growth, that your currency tends to appreciate. I mean, can investors expect a appreciating rupee in the future?
I can't say that. At the moment, the depreciating pressure is there, but that it is, it is broad. It's not very volatile. There is some depreciating pressure which was witnessed in the last few days. But at the moment, I think it seems to have again stabilized. And it is mainly because I think, you see, what is happening is in earlier episodes in earlier occasions, what was happening is that some data point would come somewhere, some data point will come somewhere, and immediately the Indian markets would respond, and immediately there will be a movement, outflow of dollars. Today it is not happening because overall the Indian economy is resilient. The macroeconomic fundamentals are stable and strong, and there is confidence on the part of, confidence on the part of the international investors. They have greater confidence that whatever is the requirement, India will be able to meet its, external payment obligations.
Interest rates. So you shifted your policy stance to neutral at the last meeting. You didn't cut Some critics have said that you're running the risk of being behind the curve, hurting the economy. Then September inflation came in higher than anticipated. Do you feel vindicated?
We expected, say, September inflation to be high. In fact, I had, if I remember correctly, in my statement, monetary policy statement, exactly 9 days ago, on 9th of this month, I had said that in September, we expect a big jump in the consumer inflation number. And we expect also a higher number in October also. But thereafter, in going into November and December, in the third quarter of this, in November, December, we expect inflation to moderate. And with regard to being behind the curve, I would like to say that, well, there can be a difference of opinion between certain sections of opinion makers or certain section of the market. But so far as Reserve Bank and the broad, overwhelming sector of the overwhelming section of the financial markets are concerned, I think expectations and thoughts are quite well aligned. The opinion poll, the polling conducted by various news, the wire services and business channels, all of them had, most of them had said that Reserve Bank will not cut, but Reserve Bank will change the stance, and that was exactly our decision. So I think market expectations and Reserve Bank's policy, they're well conversed. And I would like to say that certainly we are not behind the curve. Indian growth story, as I said in the beginning, the growth story remains intact. India is poised to grow at 7.2% according to the projection which we made in the last Monetary Policy Committee meeting. Growth is holding on, growth is steady, growth is resilient. Inflation is moderating with certain risks about which we have to be very vigilant. So therefore, rate cut at this stage will be very premature and can be very, very risky. When your inflation is 5.5%, and next print is also expected to be high. Right. You can't be cutting in, rate at that stage more, at that point. More so if your growth is also doing well.
Some economists have pushed out their forecast for a rate cut in December. Would you agree with that view, that we have to wait a little longer? You would miss the party if you don't cut in December.
So far as the Reserve Bank is concerned, you asking about India? No, we will not miss the party. In any case, we don't want to join any party. we would rather like to wait and watch. And if we decide to join the party, we would like to join it on a durable basis. In the sense that when we have confidence that inflation is, the inflation figure is durably aligned with our target of 4%. Only at that stage, maybe that may be a situation where we can think of, but I think it's too. I would not like to, make any forward. I would not like to give any guess in advance that we are going to cut or anything. I think we'll have to wait and watch. We have to wait for the incoming numbers, and please mark my words very carefully. We have to wait for the incoming data, and more than that, we are more dependent on what kind of outlook we have out of, ahead of us. So it will depend on the incoming numbers. It will also depend on the overall inflation outlook, because policy has to be basically forward-looking. So we have to see what is the future outlook next 6 months or 1 year down the line. Based on that, we would take action.
The Fed obviously pivoted with a bang in the jumbo rate cut. How much time do you spend on watching what other central banks, especially the Fed, are doing?
No, we do watch. We do watch what other systemic banks are doing, in particularly the Fed, because it impacts almost every economy in the world, and we watch it very closely. Having said that, I would just like to add, and I have done that before also, that our decisions are primarily dependent on the domestic inflation, growth, and macroeconomic situation.
Staying with America briefly, are you concerned about the potential imposition of new tariffs in case Donald Trump is being elected in the US? He was on a Bloomberg TV interview this week where he said tariff is his favorite word in the dictionary, and higher tariffs would basically solve all the problems of America. What's your view on that?
No, I don't want to go into the, what I'm saying, I don't want to link it with an election outcome, because I think world over, the people who predict on election outlook, election results, I think the track record of late has not been so good. And, yes, overall, I think geo-economic fragmentation globally is becoming a problem. And we have enjoyed the fruits of globalization. We have enjoyed the fruits of, world becoming what was called at that time, the world has become flat. Every country benefited out of it, but I think globalization probably somewhere traveled on a different direction. So various countries, the benefit that individual countries derived out of globalization was divergent. So therefore, globalization has been questioned in the recent years. But I think overall, the spirit of globalization, the need for globalization, the need for greater role of multilateral institutions and avoidance of trade restrictions and avoidance of unilateral trade restrictions or geo-economic fragmentation, I think these are impediments for overall global growth. And there is need for greater, there is need for greater cooperation and understanding across countries on these areas.
Your current contract comes to an end in December. If you look back, what are you proudest of in your tenure, and what would you do differently if you could turn back the clock?
Well, it's for others to judge. It's exactly 10th December, I remember the date. And I think during the last 6 years that I have been in the Reserve Bank, and let me preface that by saying that we have an excellent team in the Reserve Bank. I'm not saying it because some of them are present here or some of them would be watching. But it is a fact that I think we have an excellent team in the Reserve Bank, and together we have worked. And I think we have, seen India through in one of the most challenging phases in its economic history. When I joined the Reserve Bank in December 2018, a large non-banking finance company had, collapsed. The financial markets had, activities in the financial markets had frozen. There was a crisis of confidence in the financial market. We dealt with that challenge by infusing liquidity, by monitoring, supervising the financial entities with greater rigor. Then we had, that was in 2019. 2020, we had the COVID, continued till 2021. Then 2022, we had the Ukraine war, followed by, spike in inflation, synchronized monetary policy tightening across the world, and the spillovers to the emerging economies, including India. Then the crisis in the Middle East, and alongside we had geopolitical crisis and geo-economic fragmentation. So I think it has been a very, very, it has been a very, very challenging period for the last 6 years. And what gives us satisfaction in the Reserve Bank, but satisfaction doesn't mean that it's time to celebrate. I mean, because every day is a new challenge. Every day poses new problems. And I'm not saying it in a very, with just to indulge in some semantics. I really mean it. Every day is a new challenge. The world is changing. We cannot be complacent. And, but what gives us the large satisfaction is that we, I think, navigated this period with big success. The economy today remains, the macroeconomic fundamentals are resilient. Financial stability has been well maintained. And if you ask me what has been the biggest achievement of Reserve Bank during the last 5 to 6 years, I think it is maintaining stability of the financial system, maintaining financial stability. In fact, the Indian economy and the Indian financial sector overall today is much stronger than what it was before we entered this period of crisis. And that is something which I think I and my colleagues in Reserve Bank, we sort of discuss about it. There are learnings from it, and there are takeaways for the future. And we always, the effort has been to remain alert and try to see where the risks or where the vulnerabilities can, build up and try and address that issues.
You seem to thoroughly enjoy your job. If they ask you to stick around for another term, are you going to accept?
At the moment, I have this injury. I have to get over this injury. No, but on a serious note, I think, at the moment, that is certainly not in my mind. I'm being very frank about it. In my mind, what remains is that, up to 10th December, there are certain items which were initiated, and we need to, conclude them. We need to ensure that they reach, their desired conclusion. Several discussion papers we have given out in the public domain. We have adopted a consultative approach in framing our regulations. So several discussion papers have been placed in the public domain. The comments have come up. I have asked my colleagues in Reserve Bank to try and examine those comments, and our effort will be to try and issue whatever regulatory guidelines or directions arising from those discussion papers. My effort is at the moment completely focused on completing that job, and next monetary policy meeting will also come up. So already my table is full, so I have no time to really think of what next. We will see.
Okay. Well, our screen here says time is up, so sadly we have to end this. Thank you so much.
Thank you
for coming, and thank you for listening.
Thank you.
Thank you so much. Please.
Our next conversation is on India's credit market evolution and opportunities. The business of loans may have evolved from traditional cooperative banking to high-yield private credit and instant finance. Yet India's domestic credit to the private sector stands at just over 54% of GDP versus almost 200% for the US and China. Is that big enough for the world's fifth largest economy? To discuss that, please welcome to the stage Kanchan Jain, CEO of Assertis Credit Group, Prasanna Balachandar, Group Head Global Markets, Sales, Trading and Research at ICICI Bank, and Pramod Kumar, CEO of Barclays Bank India. Moderating the discussion is Bloomberg's South Asia Managing Editor, Jeanette Rodriguez.
Good evening, everyone, and thank you very much for joining us today. We just heard the governor. The India growth story is just starting, but there's no hurry to enter any rates party. Taking off from there, of course, one section of the population, one segment of the industry that really wants to join the rates party is of course always enjoying the party, whether it's up or down. To start, I want to just generally give you a state of play in the Indian industry. If I could start with you, Kanchan, how would you characterize the Indian credit markets right now, especially given the growth outlook that the governor has laid out? Are we really equipped to deal with the growth story that we're looking for?
Thank you. Glad to be here. I think when we think about the broader picture, I would say I would have sort of three, quick points to make. Firstly, just the recognition that, debt capital plays a very important role in whatever growth plans we have and the significant growth plans that we have. There are certain end users, certain requirements that are just better met through debt, and we need to solve for that. And I think it also creates a bigger wealth creation opportunity in the domestic markets in the hands of the entrepreneur. I think the second thing, which is an important point, is just different forms of debt capital, right? We are a bank-dominated debt capital market. But between bank and real non-bank source of capital, there are, very important differences. So banks effectively create credit out of depositor money, right? And therefore, the entire banking model sort of lends itself very well to granular, vanilla, wholesale lending businesses so that you have a predictable performance. Non-bank, on the other hand, and I think for the sake of simplicity, let me talk about just the public securities market, and of course, the governor referred to this as well, which is the private credit market. They are solving for very different end users of capital, right? They are solving for very different needs of the capital. And I think the important thing for us, all of us to recognize as we solve the credit puzzle, is that we need all three sources of capital. These are three distinct sources playing different roles. There is opportunity for all three to coexist. unlike global markets where bank credit has sort of come down and private credit has gone in, I think for us it's going to be, complementary sources of capital growing together. And I think the last but not the least point is just where we are, state of the market, right? And I think both in terms of banking regulations and the banking sector state, we are at a good, healthy state. It will remain the mainstream credit provider in the market, and we need that. But I think likewise, if you look at debt capital markets and private credit market, the recent regulations, security market regulations and the changes that have happened have created a very good foundation, right, for us to build on that. I think it's important to recognize the opportunity that we have ahead to build that further, but also to recognize that these are very essential components, every one of them, for us to meet our goals and, to sort of build on that.
Thank you, Kanchan. Prasanna, speaking, of course, from Kanchan spoke from the private credit perspective and more broadly, of course. Going back to the traditional banking sector, where do you think we are in terms of the industry that we need, especially when it comes to channeling capital from across various dimensions?
So I think I agree with whatever Kanchan had to say, and in fact the governor made a lot of valid points as well. So actually, if you really look at any economy, especially a growing economy like ours, we need a reasonably good combination of, when you talk of credit, I'm assuming we talk about bank credit as well as the non-bank credit that she spoke about. So you need a good combination of bank credit as well as non-bank credit. You can call it credit versus capital market bonds as well. And in the past, I think India has been a country which is predominantly a credit-funded, bank credit-funded economy, if you will. But in the last 10 years, things are changing. And if you see the corporate bond market, it's been growing at around 10 to 11% on a CAGR basis. You see the incremental amount of credit that's been given out by the banking system has been consistently reducing from around, say, 74% 10 years ago to around 60-63% right now. And when you look at the demand side as to where these pools of non-bank money is really coming from, and I think Governor did touch about that as well, if bank credit outstanding is in the region of around 160 lakh crores, 160 trillion if you will, you have mutual funds at around 18, you have PFs at around, provident funds at around 40, you have insurance companies at around 55, and now the newest baby AIFs is close to 10 trillion. So if you really add up all of this, it comes to close to 60%, and this number was much lower a few years ago. And really the boom that is going to happen over the next few years, and which has actually started, is what we are now calling it as the private credit, and that's why this is very contextual and very timely that we are having this now. And the fact that globally post GFC as well, we saw the AIF industry grow phenomenally, primarily because banking, there was a lot of regulations which are coming in terms of stifling the banking growth, because that is one of the sources of the GFC in the first place. So we saw that that is coming up in a big way globally. And from an Indian perspective also, if you see in the last 3-4 years, suddenly we are looking at a 10 lakh crore number from the AIF industry. And most of it is actually coming from credit-based funds. So I think bank credit is good, it's big, but the future is going to be on non-bank credit. And both of it will subsist, but incrementally, I think the other forms of credit will become that much more important than bank credit. We can talk about what is ailing the bank industry, but maybe we can talk about it a little later.
Lots of questions.
I just want to add one point which I wanted to make earlier, is that I think the difference that we need to recognize is that, as I said, banks create credit out of depositor money, right? That model is very different from debt capital markets and private credit, where you're channeling, you're not creating credit. You're simply channeling existing savings and investment funds into productive end users in debt form, right? So when you think about the risks and systemic risks out these,
so I want to talk about that, but later on if I have the time.
Yeah. I'm sure our audience is all ears, because that's a very pertinent question, of course. Where is the money going to come from to channelize it? Which is a cue for you, Pramod. What kind of a role do you see for foreign banks in a market that's set to get more sophisticated, bring in more complicated, if I may, structures and products in? How do you see foreign banks playing an elevated role here?
Look, on two fronts, I guess. One is, helping Indian borrowers access, international bond markets, international syndicated loan markets, and I would say reasonably strong, well-versed foreign banks play an active role in even facilitating credit on the INR side as well, whether it's not significant amount of balance sheet loans, given we don't have large deposits unlike the large domestic banks, but we do have the ability to syndicate and place that their debt with either the asset managers or the insurance companies or the provident funds and the pension funds. So they do play a role. I think the other area where we are seeing increasing amount of opportunity here is in securitization. I would also say channelizing through the AI fruit or otherwise the high net worth individuals or through our private bank also credit flow into the system. So I think it's across all different components of the credit sort of curve.
And of all these components, what excites you the most? What is Barclays most interested in this space?
Look, India is an exciting place without doubt. We're not seeing that sort of growth and market opportunity anywhere else in the world. It's pretty stable. It's constructive. It's attractive market. So if I were to say over the last few years, we found opportunity across all possible forms of credit. The global debt capital markets have been very active. The credit funds, we have, structured credit business, we using that. We're doing securitization. So I think India just is presenting a reasonably attractive opportunity for growth to every participant.
And Prasanna, you mentioned, you hinted at it right at the start about the kind of breakdown that we are seeing. The governor, of course, spoke of geopolitical dislocations, but there's a dislocation happening within our financial markets where everyone is worried about the deposit growth here. And how does that feed into the growing demands for credit? Where do you stand? There are all sorts of reasons for this happening. Where do you stand on that debate?
Yeah, so first of all, I'll agree with Kanchan that banks are the second god. I mean, Reserve Bank creates the primary money and banks can create M3 by simply lending out the deposits that they're getting, and it's a multiplication factor. But the thing that we need to note about is two things. One is the guidelines for impounding from the deposits, which is by way of either government securities or by way of cash reserve ratio, as per the new guidelines is almost close to 32%, which means every 100 rupees that a bank gets, 32 rupees is not going to be used for credit. So you're going to use only the balance 68 rupees. And this ratio is the highest in the world. If we implement that guideline, already we are the highest in the world, we'll become even more tougher. So that makes the credit creation cycle that much more, difficult. The second thing is there's a lot of talk about money going into equity mutual funds, and that's why banks are not getting deposits. Bear in mind that when people talk about banking deposits, you talk about aggregate banking deposits, you don't talk about the fixed term deposits that the bank is getting. And aggregate term deposits includes the money that is in the system. So when you put in a money in an equity mutual fund, it doesn't go out of the system, but it does two things. One is money goes away from the retail to a wholesale kind of a deposit. So if an individual puts money into a mutual fund and the mutual fund has a current account with a bank or actually buys from another person who sells, the money is actually going away from a retail individual to a wholesale, and that entails a higher LCR ratio. And that means the bank, instead of getting to lend the money that he is getting now, is actually going to buy government bonds. Government bonds are HQLA assets. We can talk about it later. And the second thing it does is it moves away from longer term funds to very short term funds. And hence a bank cannot really use it for lending. So these are the two things that is kind of breaking this credit deposit cycle. And that is the reason why you see this break in the last couple of years. And also one more important reason, if I may just take a minute more, because it's important people understand that. Typically, if you take a deposit and you buy a government bond and the government spends that money and that money comes back into the system, even that does not really break the credit cycle. But what creates the leakage is if the government takes the money from you, you have invested in the government takes the money from you but doesn't spend and builds its bank balance with the Reserve Bank, then there is a cut in the credit deposit cycle again. So we've seen government deposits, government WMA balances going from an average of around 25-30,000 crores, say 4-5 years ago, to something as much as 4 lakh crores now. And that is the amount of reserve money destruction which has happened. But this is a one-time affair. Government can't keep building 4 lakhs, won't go to 8 lakhs. So our hypothesis is this problem will solve on its own over the next 1 year or 2 years. Whereas in the short term, people might have a problem in terms of things. But the thing about financialization of saving going into equity and all that, that is there for sure. In fact, that's a good thing which is happening. I don't even want to say that the equity mobilization should be less and debt should be more. There are some problems with the debt asset class. Again, I'll talk about it later.
Very quickly, if I could ask you a yes or no question. In December, if Governor Das is reluctant to cut the repo rate, should he tinker around with the other ratios in the market?
So, okay, I mean, looking at what he said today, he's given enough doors not to cut as well as to cut. So let's hope what he does is good. But the question was?
The question was, if he's reluctant to cut, should he be cutting the other ratios?
So there is a representation that we have given to them that the LCR guideline is very draconian in nature. And the fact is, if RBI wants transmission, it wants transmission in the direction of its rate change. It is very possible that they will be cutting rates and bank deposits will be going up if the LCR guidelines don't change. So that is like transmission brake. It's not just an extent of transmission, it's the brake in the direction of the transmission itself. That doesn't serve the economy, that doesn't serve the rate cuts as well. So
in a scenario where banks don't have those deposits, there is a clogging of the pipes, so to speak. Kanchan, what kind of role does private credit have to play here?
See, I think fundamentally, as I said earlier, private credit is not replacing banks. That's not happening in our lifetime, right? What banks provide in terms of bread and butter finance or working capital, sort of project finance, will have to stay, right, in the system. I think what private credit solves for is a lot of end users that are more structured, that are more bespoke, that banks can't provide, right? Now, the important thing to recognize here is you have 1,000 crore precision engineering component manufacturing company, small size company, but it's been set up over the last 20 years. Everything that we are seeing in terms of tech transitions, tech enablement, supply chain disruption, China +1, there is growth happening across the board now. So the need for structured, customized capital is no longer just the large conglomerates. The 1,000 crore company that has 100 crore EBITDA is looking for 150 crores of acquisition capital. Where does it raise that from, right? And that doesn't come easily from banks and shouldn't come. Because for me, it's not about banks not lending certain kind of money. If I was the CRO of the bank, I would want exactly the same thing. Let's just do things that we know that give us predictable loss ratio. I think those are the things that private credit solves for, right? The debt capital market side, which is the public security side, provides us, public price discovery, transparency, provides us diversification of risk holdings when a conglomerate wants to do 1,000 crore bank issue. But somebody wants to raise 200 crores for acquisition, 250 crores for more structured. That is what private credit is solving for. So I think the thing that private credit only does credit, which you can't get from banks, it's too risky. I think that's only a part of the thing here, right? There's a lot more end users that private credit solves for. And if banks stop lending, I don't think private credit is the answer at all.
And Pramod, that brings us neatly to you, because Kanchan spoke about the fact that in India, the private credit market is different from how we understand private credit globally. And that's partly because the large banks are only giving money to the large business houses. Why is that?
Look, if you look at last 10 years of overall how bank credit has grown, I would say we've seen a more consumerization of bank credit, right? And that is because banks really suffered very high ratios of NPAs until a few years ago when banks were capitalized. There was some, NBFCs restructuring and all of that happened. But the growth that we've seen in the consumer credit has far outpaced the credit growth to industry, right? So I think the credit growth to industry in the last 5 years has been just 5%, while for the overall industry, bank credit has grown at probably 13-odd%. So that clearly shows. So it's a function of what banks went through and where the credit demand really came from. I think banks, in a way, are also indirectly serving, the industry growth through NBFCs. They also lend money to them, but they sort of, do it in a different fashion, in a more sort of quicker way. But banks have, in the last few years, lent more money to personal loans, consumer, etc., than industrial growth. As a result of which, I think there's been if I could admit that there's been some bit of aversion on banks' part to lend large sums of money to corporates outside of, I would say, two exceptions. One, large industrial houses that have the ability to navigate all this and have the financial wherewithal to be able to, undertake large projects which are less risky. And second exception is infrastructure projects where there is sort of concession and long-term concession, and those are projects easy to underwrite. So it's really been a function of, I think, what banks went through and where they see larger opportunity, and some bit of risky opportunity has been left for other forms of capital to provide, right?
Prasanna, if I could turn to you, because I'm hearing a common theme here about a lack of ability to price. Between all three of you, one would think that the Indian market should be self-sufficient in capital, because the consumer, the big industrial houses, and where the banks will not go, all of them are being served. But is there a problem in India where banks and financial institutions, both bank and non-bank, are unable to price risk?
No, I'm not sure I exactly got what you mean by pricing risk, but I can tell you that credit appraisal skills are something that is what is going to enable you to price a particular credit properly, and banks have that skill. And now AIFs increasingly who are going to be into this will also need to, if they have it, if they become bigger, they need to have it. But the point is, if you really think about risk, I mean, you have a credit spread which accounts for the kind of credit risk which is there. And I do agree with Pramod about the consolidation, the large houses and all that. So what's typically happening is that banks, by virtue of the kind of mandate that has been given to them by their investors, are getting away from lumpy growth or lumpy credit, which is what happened between 2013 and 19. You referred to that. And the kind of brickbats that banks got from investors, I think they have learned the lesson. So they're getting into retail lending at one place, and they're also getting into granular growth rather than, giving large infrastructure-led loans. So I think the space that is getting vacated by the banks, there is definitely, that is what can be captured by some of these institutions like AIFs when they get the money. Because there's clearly a gap between that. And of course, if you really look at it, FPIs, Governor himself mentioned about it, but he was again thinking about government bond investments. The fact that India borrows so much in government bonds means that anybody who wants India exposure from a rate perspective is satisfied buying government bonds. And there is a gap even in that. So why would the FPIs get into even corporate credit? Ideally, we should be in a situation where we are able to draw credit from abroad in the form of corporate bonds and FPIs to invest in that, because that's where the capital, really is.
And in a market that has the realities that we have, do you think, Pramod, we'll be able to fund the infrastructure needs that our country has?
To a large extent, in the recent years, government has taken upon itself to actually fund a large amount of infrastructure.
But that's in certain sectors. Yeah. There's still a need in other sectors to get private credit in.
Yeah, I would say, look, outside of big road projects, infrastructure, investment in renewables in particular, has essentially been led by private sector. Governments created a good framework and counterparty risk by having, instead of state electricity board as off-takers, SECI or NTPC sort of this thing. Though they've created that enabling environment to be able to attract private capital into this. But of course, India's credit requirement is pretty large, and it has to access every pool of, I would say, capital, be it project finance loan, be it sort of working capital loans, acquisition financing and others, to be able to fund this. So, I think we will continue to, which is where we're seeing a lot of demand, both from global investors, funds, etc., to put money into the country, because there is a huge need given the 7% plus GDP growth and infrastructure investment.
And in all this story, which seems superficially bright, Pramod, where are the risks?
Look, as you integrate your domestic market with international markets, you obviously carry a risk of global events and flow of money. We've seen that in equity markets in the last few days. We could see that if global geopolitics sort of plays differently. Today, with I think the global interest rate outlook, I would see that should really result in more capital coming into the country. If we continue to show strong growth. So I would say risk is inherent as we integrate ourselves and access different pools of capital. There will be greater volatility in accessing certain forms of capital than the traditional forms of capital. And I would say global geopolitics that is affecting, in this sort of world that the governor described as deglobalized world or not so flat, right? So those are the risks that I would see.
The governor mentioned external risks. Even other people we've been speaking with, especially over the past few weeks, have been mentioning the risks to India come from abroad. But are we missing something domestically? Is there something that you are particularly concerned domestically as well, Prasanna?
To me? I actually do think that risks are far more likelier to come from abroad than domestic. In fact, the only risk that I can think of on a domestic side is on the ability to absorb the labor force, the huge population which is getting into the working age, to absorb them into work. I think that's going to be the primary, from an economic growth perspective, the risk factor. But I think the financialization of savings and the things that are happening is so fantastic that I think we just need to enjoy the ride and just hope that no risks, bloom out. Having said that, let me just make one point. I'm not sure if I'll get another chance at it. I think as a society, I think we need to get the culture of investing into debt back. I'm sure I'll find support from the next panel who are going to talk about that as well. But the point is, I'll recall when in a dinner table, a neighbor who was a doctor was actually asking me, where can I put my money? And I told him, shift from equity to debt. And he asked me, is it safe? So that's where we are. We think equity is safer than debt. And the risk-return matrix, we've got it all mixed up. So I'm not saying you should not encourage equities, but don't discourage debt. I think India needs money to fund its growth. So you can look at encouraging all kinds of investments to get that, more capital market flows into. So both equity and debt can do a good job. So instead of having only debt being taxed at maximum marginal rate, when even real estate is at low percent, and at least you can get that on par. Don't bring this up, but at least bring that down and make it equal to everything. And I think we need to get that debt back, and then you will get more money being mobilized by mutual funds, more probably mobilized by AIFs, and hopefully from banks also.
In a room where we have 3 regulators today, there are plenty of points that you've raised to think about.
No, in fact, you did a great thing by sandwiching us between 2 regulators.
Well, hopefully the message goes, we have until now, till December, where various policies are coming out. Kanchan, speaking about risk, speaking about equity and debt, we've mentioned all those asset classes, private markets, of course, and private credit, new asset class, hot upcoming asset class with a lot of excitement and curiosity. Is there education needed about that, or is there the intention that it will only stay among the sophisticated borrowers in India?
I think it will stay amongst the sophisticated borrowers, and I think that's fine. It is a long-term, closed-ended investment product. It's a debt investment product. So, and I think that's where the regulation has sort of settled down, which is only in AIF form, which I think is absolutely fine till the industry grows, right? We're less than 1% today of the bank credit. It grows 5 times. We're still going to be less than 3% of bank credit. I think the interesting opportunity for us here is when we think about pension funds and insurance companies, both here and internationally, these are real money investors looking for real return, right? Their return requirement on a year-on-year basis accumulates. If they need to make 7% return, it has to be made. They can't have a shortfall. And it's not linked to the level of interest rates. So what they are looking for is avenues and economies like us where there is real growth happening, right? So the opportunity for us is that one, yes, not go retail, stay with sophisticated, but within sophisticated, there's the sophisticated HNI, and there is the sophisticated institution and tap into that pool, because that's a completely different source of capital. That's not the same capital that invests in private equity. That's not the same capital that invests in public equity. We have right now the opportunity to learn from how this asset class has evolved over the last 20 years in the more developed markets and convert that into a separate source of capital that's going to be stable, that's closed-ended, that's long-term, and that's looking for moderate returns. We don't have the risks of market volatility, market valuations, and hot outflows from the economy.
I want to play devil's advocate a bit there and throw this question to all three of you, especially Kanchan and Pramod. Yes, India is growing at 7%. Yes, there are certain benefits to this market. But in a world where China is arguably a diminished player in the room, there's Indonesia, there's Vietnam, there are various countries that can offer those growth rates to foreign investors. Especially Pramod, what are you telling your global offices? Why should they prioritize India and not Indonesia or Vietnam?
Look, relatively they are smaller markets as compared.
Is that the only benefit?
Yeah, definitely that's one of the key drivers, and I would say there is a greater comfort on the strength of the economy, right? Actually, that's also a problem because we're also finding credit that you alluded to is getting mispriced because there's so much money that's chasing, people are compromising on really the underwriting standards or the right sort of, pricing. So we're seeing that as well. But I would just say it's just overall it's a stable democratic setup. Inflation seems to be getting under control. There is a rule of law. It's large market. So all of those things certainly play in India's favor.
Contract enforcement, Prasanna, are you satisfied with the level of contract enforcement we have in India?
Oh, well, I'm not sure I can comment on that. You said about contract enforcement.
Pramod said there's rule of law, there's democracy, there's a lot of pluses in India.
Yeah, so I can tell you about one plus, which is very clearly the size and the diversity that India offers is, I think, next to US and China, I think it's India. Because you have so many industries, you have so many large industries, and the ability for India to absorb a lot of capital and the ability for us to, take capital in multiple different industries is, I think, unparalleled. You have other countries which are large but are commodity driven, other countries which are small but have the kind of diversity. India offers both. And you know what's happening in China. So I think next to India, next to US, it's India which is the main thing. On contract extension, I would maybe divert it back to Pramod.
It is better, right? I mean, it's come together very nicely. One of the lesser things we don't talk about as much. Everybody talks about the IBC code, right? And it's about glass half full or half empty. But one of the things that enables credit markets in India is the presence of credit bureaus, right? And the penetration of credit bureaus amongst corporate markets, right? That is a big enabler for running a credit strategy, right?
So one thing, I'm sorry.
No, go ahead.
No, one thing we should surely do is to get the IBC cases to be resolved much faster. The fact that it has come up is extremely good, and I think AIF as an industry would benefit from that a lot. But I think the kind of cases which are getting resolved and it's taking too much time. So if you can set up a track record of cases getting resolved and you get the recovery rate to be known, then I think you can get a lot of junk bond investments and lower credit investment. I think the singular need for India is how do you attract money for less than AA
Increase the spectrum of...
Absolutely. Yeah.
Thank you very much. A lot to chew about.
Thank you.
To Prasanna, Pramod and Kanchan. Thank you very much.
Thank you.
Time is up. On to the next panel. Thank you.
The next conversation is on private credit and alternative investment in India. Private credit deals are on pace to almost double in value this year. Alternative investment funds have commitments of close to 12 trillion rupees. That's a fifth of the assets managed by the much older mutual fund industry. Globally, big players like Blackstone and Apollo are making the most of the $1.7 trillion alt funds boom. So who will win in India? To discuss that, please welcome to the stage Lakshmi Iyer, CEO, Investments and Strategy at Kotak Alternate Asset Managers; Indranil Ghosh, Managing Director and Head of Pan-Asia Special Situations at Cerberus; Amrish Baliga, Managing Director, Deutsche Bank India; and Maheshwar Natraj, India Private Credit Lead at BlackRock. Moderating the discussion is Bloomberg's Global Executive Editor for Credit, Shannon Harrington.
All right. Well, thank you, everyone, for being here. We get to talk about the buzzword of the day, which I think we've hit on in every panel so far. One thing, though, I think what I've learned is that private credit is a nebulous term. Can mean lots of different things, and often depends on where you are in the world. It is also something where typically when you see the traditional banks stepping back from a particular sector, that's when the private lenders go in. So I was hoping we could just kind of set the scene a bit. And Amrish, I'm going to start with you. What exactly, just give us some color on what exactly private credit means in India. What voids are being filled?
Well, Shannon, first things first, thank you for having me here. It's an incredibly august forum. My fellow erudite panelists are, they set a high threshold. Some of the panelists before we joined this forum, particularly Kanchan, even Governor Das to some extent, ran through a gamut of what private credit could entail, and I think Kanchan kind of nailed it, right? So private credit, as is understood in, let's say, the developed markets, which is largely you have the bank market, you have the institutional market, and then you have basically private credit funds, either housed within private equity or credit funds that are standalone, like the Oak Trees of the world, the Blackstones of the world, that offer a channel that is separate from the vanilla banking, right? Which is essentially a lot more bespoke. The instruments are structured, yields are naturally higher, and collateral is generally something that they are a lot more comfortable with, which stands out of the traditional fixed assets that come with some of these, some of the large vanilla debt that comes about. In India, to some extent, that is the norm, but it's gone through various, scenarios, evolved over time. But 3 or 4 key basic tenets are a bespoke instrument, higher yield, collateral that has to stand the test of time, and the additional avenue here is structuring it within what regulators, notably the RBI, has to do, right? So it's a balancing mix, but quite candidly, my Deutsche Bank has been doing this for close to over 3 to 4 decades, and effectively speaking, we've gone through. It's like an old wine in a new bottle, proverbial, right? I mean, effectively speaking, we've called it structured finance, we've called it bespoke lending, all of that. But essentially, the 3 or 4 key items is bespoke, I would say higher yield, to some extent collateral not being the traditional fixed assets, and a lot more structured than what vanilla debt would be. So if we look at that corpus, that is broadly what constitutes private debt, private financing, private credit.
Okay. Lakshmi, I'm eager to hear your take on this, representing the loan domestic firm. And when we were walking on stage, we heard some of the numbers from Menika, the growth. I think we had a story that we might be looking at the first $10 billion year, depending on how you measure it. From your perspective, what is driving that growth, and how are you approaching this market?
Yeah, hi, good afternoon, everyone. So firstly, I think the most important thing is that, and we heard this in the previous panel, is that there is already a very strong beeline being made towards equities, which is largely the listed equities. And investors have tasted, you call it blood, success, or as the case may be. The Indian fixed income market, if you see, which is the other formidable asset class within the financial asset class piece, the sovereign yields are not that very lucrative in comparison to equities. So when you have to offer a solution in that space, the next formidable name that comes to mind is obviously the private credit. Within that, of course, there are various ranges, right from performing credit to very high yield, bespoke structures. But that pool of capital is chasing returns. And returns in a very, very, I would say, kosher manner, where there is, it need not be the stressed asset space, which has obviously 20 plus, 22 plus kind of returns. Also, if you look at, so that's one part of the thing, that's on the demand side. Also, if you look at the entire landscape of the banking industry right now, we are sitting at over a decadal low of NPAs. So there's a lot of repair which has happened on the balance sheet, and that has, and coupled with the fact that corporates in India have deleveraged. If you look at the net debt, in balance sheets, it's substantively shrunk. So that's creating a very happy space for private credit to exist. And I think a combination of supply and demand, and the fact that, again, the earlier panel stole most of the thunder, but I think I'll just put it in different English or, kind of just to make it more coherent, is the fact that there are other avenues which are coming up aside of the banking sector, which is able to funnel that, increasing supply. So a supply meeting demand kind of a scenario with a potential to be able to deliver, a higher return and a reasonably higher return compared to what sovereigns in India are offering. I think a combination of these two factors is what leading, to the proliferation. And, there is a, after Coldplay, I think it's the credit market which is having that, the FOMO feeling, the fear of missing out, which is where you're seeing most of the money is flowing in.
Just to elaborate a little bit on that, specific to being a local firm, there's a lot of capital sort of lining up around this market. Do you see the local players having a bit more of an advantage than some of the others coming in?
So I'll say there are two parts to it, and I know we had a previous session of the regulator, and the next session also is that of a regulator. But I must say that when it comes to the infrastructure, when it comes to the domain expertise and the team which is resident in India, having tracked, for example, in this space, we call ourselves a 38-year-old startup, in that entire ecosystem as a group. And in the private credit space, we have over 2 decades of experience. It's not really a level playing field from a regulatory perspective. And there are too many things which are in the works. There are, white papers and brown papers which are being floated around right now, which is talking about, how it is incrementally becoming very difficult if you are an entity which is regulated by the Reserve Bank of India, and if that entity is the sponsor to any alternate fund in the country, there are ABC things vis-a-vis XYZ things for an entity which is running a similar practice but is not a central bank regulated entity. So I would believe that from that perspective, and if that actually sees the light of the day, then it would not actually be a level playing field. But yes, in terms of capabilities, in terms of infrastructure, I think because there is hands, ears and feet into the ground, I think the domestic guys have been able to size and scale quite meaningfully and substantively.
Okay. Maheshwar, hope you can give me the BlackRock view here, and as a firm that's coming back in to India, the approach that you're taking in this market.
I can speak for the industry, but if you really look at it, I think, there is an advantage to being a global player, because you see asset classes across different geographies. You look at the same asset class across different investment grade rating to high yield rating. So you have a better perspective as far as that is concerned. So there is a learning curve. There is a benefit to both. As she rightly said, there is a benefit to having boots on the ground, and there is also a benefit to having a global presence, a global learning curve that's pretty much rhyming in history, right? So that's how we would kind of look at the situation.
Okay. I want to shift gears a little bit here, and Indranil, let's talk a bit about the risks in this market. We had Governor Das was talking about globally. There's obviously a lot of concern. When you get a fast developing market like this. What are you seeing here? Are you seeing any? And I guess maybe to start, given anytime you get a hot market, you're going to a lot of capital flooding in, and things get overcrowded. Is this market overcrowded here?
Yeah, I think competition, as you rightly mentioned, is inevitable. And honestly, competition, while it impacts all of us, I think is a good thing, right? It sort of deepens the market. I think the challenge, emanates from the quality of competition. We've seen a bunch of first-time managers raise a lot of local capital. And with some of those managers, I suspect that the underwriting standards, the diligence standards, the structuring, the covenants are slightly sort of lighter than what a lot of the global firms and well-established domestic institutions are used to. And I think that's where probably lies the kernel of risk, where this market really hasn't seen a credit cycle. And the first time we see it, and it's inevitable that a market like this will see a cycle. I think some of those weaker credits will quickly sort of pose a challenge to the market, which will result in consolidation eventually. But I think that's where some of the risk lies at this point in time.
Just to add to what IG says, right? There are two ways to look at this, Shannon. One is the more the number of entrants, right? It creates an avenue to distribute some of that risk, and that's actually one of the critical hallmarks of getting private credit strategy right. It's not just you can't just take and hold, and effectively if the quality of credit deteriorates, it impairs your book seriously, right? So on the one hand, you have a ability to distribute a lot of that risk. IG has participated with us on several trades. We buy paper from him all the time. It's relatively, I wouldn't call it incestuous, but it's a pretty close-knit market as it keeps growing, and that's to you probably answer some of your other questions as well. But the downside, and I agree with Indranil here, is that if there is a bust up when you actually go through a complete credit cycle, then that's when you separate the men from the boys. And that is something that we have yet to see, play itself out in terms of how the regulator will look at it, how our own risk folks look at it, and essentially what would be the impact on the market.
Lakshmi, can you address? And I guess I want to kind of know what are the things that you're going to be looking for when that cycle.
So Shannon, my view is that risk is agnostic of which entity is. Whether it's an Indian player or whether it's a global player, it is about being able to have very, very strong governance in place, not deploy under duress. I'll tell you, we raised, the first, our maiden private credit fund, which is close to about a little under $200 million, and we just deployed 51% of it. 49% is undeployed, not because there aren't opportunities. There are opportunities in the market, but everything looks good at a price, at a reasonable price. It's not BAAP. In Hindi, it's called BAP, which is buy at any price. So what's happening in the market today is with the proliferation of credit funds, the buy at a reasonable price, BAP, B-A-R-P, is getting, transformed into BAAP, and therefore there is a possibility that some of the covenants could get diluted. That doesn't mean the credit is bad. So I think there has to be a very, I would say, optimal balance of how you are raising the money vis-a-vis how you are deploying money. I would say we are just at the tip of the iceberg as far as the size and scale of the credit markets in India are concerned. There is enough and more for everyone to be, partners in each other's success. But the tendency to be the... Do you see Kaun Banega Crorepati? There is an Amitabh Bachchan show which, he is there, and it's called Fastest Finger First. fastest finger first doesn't work in the credit market because you will lose the money. The tendency to lose money will be the highest. So I think that is something we need to keep in mind. The bigger, and I think Indranil mentioned that the thing is that if there is going to be a fly-by-night scenario that, oh, you know what, I just want to have a foot in the door and therefore I want to have this also as a strategy, it is like a Chinese, restaurant, specialty restaurant serving you a pasta. It may not be the best. So I think some of those things is what one needs to keep in mind as an investor and obviously as an asset allocator. So that's something where you need to keep the balance. But I think what we saw in terms of size and growth in the last 3 years, the numbers look very exaggerated because the base is low. But I think if you compare it versus the global standards or even the Asian standards, we've barely scratched the surface.
I mean, Shannon, we don't really know, because a lot of these deals are highly bespoke. Some of these deals that you do with private family offices don't find pride of place, thankfully, on either your August forum or any other news article. But these are large tickets. Sometimes they're collateralized by the equity of the founder, which may not necessarily be a hard pledge, right? So large trades, bespoke trades, but no one knows. So to actually get some clarity around what is the size and how do you forecast it going forward is going to be very tough.
Right. So I know, and we hear this. I hear this a lot. When you start talking about risks, I think you guys will have the luxury of saying, well, we can. It is bespoke. We can make sure we've got the right collateral, the right covenants. When you get a very hot market, though, and we've seen this play out in many other markets, discipline starts to erode and people start chasing yield and it becomes sort of a race to the bottom. Maheshwar, if you can just address that, and how are you, how can you be confident that here domestically you're going to be able to avoid that and keep that discipline that you are talking about?
Eventually, it's the system that determines, consistent levels of diligence, consistent levels of governance, consistent levels of following protocol. Has time and again, tested that it works, right? So, typically, any situation that you would want to underwrite is, you would want to see whether A, the business is underwritable, B, is the business is diligenceable, and C is you believe that there is adequate equity cushion basis whatever normalized value that you would want to underwrite at. And if you keep being consistent in your policies, your processes, I think eventually you will land up, you will make mistakes, right? There will be 1 or 2 deals that don't work, but if you keep your processes and protocols in place, I think eventually you will be able to build scale in the business.
And if I may add to that, I think one of the true advantages that global managers have who are investing out of their global pools of capital is the fact that we don't necessarily need to allocate only to India. And there is always a relative value conversation, a relative value debate that's happening. And I think that, honestly, to some extent keeps us, that's basically our guardrails internally, and that keeps us honest.
No, it's also, if you look at the key 3 or 4 criteria, right? The very basic, you can go through every financial ratio analysis. All of us have the teams or the know-hows to do that ourselves. But if you look at your client, your counterparty, first things first, ability and willingness to pay you back. Number 2, basically, are your covenants tested in the event? Because like I said, if it's bespoke, these are out of the regular APLMA loan agreement drafts, right? Number 3, if this was to ever find itself in the IBC, what is the timeline taken for you to get your money back? How enforceable is it? How liquid is your collateral? If you find a tick and you keep that discipline, right, to Lakshmi's perspective, you don't have to run, race to the bottom. If some of these criteria are met, you apply it to any of the big business groups trying to do interesting stuff, or a mid-cap that has collateral above its pay grade, you have your trade. And hopefully we distribute it amongst all of us, right? So that's the easiest way to do it.
Yeah, and I think one more key thing, which skipped my mind also is how high is the skin in the game? in terms of one's own capital being pumped into these funds. I think that's also incrementally going to start, being looked at with a larger lens, because there is more and more money which is getting pumped into it. And if a restaurant can advertise saying that the owner eats here, and that gives a lot of comfort to the investors out there, I think incrementally getting to be a higher proportion of sponsor into the business or into the fund, I think could be a potential next game changer, which probably could separate, I would say, wheat and rice. I wouldn't say men and the boys because I'm the lone woman here.
Yeah.
So.
More than formidable. Just recent conversation on a live situation, which obviously I'm not going to get into specifics, but Neil and I had a conversation. We said that, look, as Deutsche, if we look at extending some of these terms, we will back this up. Up to a point, he listened, and then when I said we will back this up, he says, can I participate in the backup, right? Because till then he was being aggressive, saying, how do we test this? How do we don't know whether we agree. I said, no, we're putting our money where our mouth. No, we'd also like to do the same. So I totally take her point. If you look at a interesting hold criteria, that gives a comfort to the entire guys that you're distributing it to, right? And effectively speaking, the trade gets a lot clearer to get done in terms of, and not just a race to the bottom, but keeping it real in terms of the credit discipline, that we get, that we don't have a blow up, 1 or 2 years down the line. Some of the trades we do are massive.
Let's think ahead a bit here. I think it was you, Lakshmi, who talked about the tip of the iceberg. And we've seen private credit evolve in a lot of places around the world. What is next? What's the next frontier for this market in India?
So I think bulk of the monies up until now, I can tell you two parts to it. One is within the performing credit or in the private credit space. For example, us as GPs, we've seen bulk of the monies being raised outside of India. I would say out of $100, more than 98, 99 is actually outside of India. The next leg of growth driver of this pool of capital is actually going to come in from India. That's a trend that we are clearly seeing, and there are again two reasons for this. One is that the money is outside of India. It's not that they are fed up of India, but their threshold is just increasing in terms of the dollar return, because US is offering, the sovereign US is offering 4% plus, and there is 8 to 10% dollar yields available outside in the US itself. So therefore, the watermark for an investor outside of India to pump in money incrementally into India, the watermark has got higher. That's point number one. And second is that the Indian pool of capital, which up until now did not really have a tangible access to this pool of investments, is now getting, I would say, popularized in two forms. One is in the form of investments into the fund, and second is in the form of co-investments. I think so both of these are happening. There's just one caveat to that, is that there is a possibility or a potential that in that bargain of that excessive exuberance, there could be some, this very big category of underwriting and downselling. Now that downselling market is also getting to be bigger and bigger, and they are in a sense performing a pseudo portfolio management role. So that obviously, you see, with every pro come a con, but I think as long as the pros are outweighing the cons, I think we should be okay. So I think that seems to be the next leg of driver of the credit space within this system.
I think one good thing is, as you will see more AUM, you'll see more deals, you'll see more exits. I think it just has an amplification effect, right? More people start getting comfortable with the business, more, the way the framework works, the environment works. I think you will start seeing more build up gradually. And you will see a participation across the yield spectrum with more niche asset allocators, wherever they want to play.
Yep.
I think the other unique thing about the region here is the limits that are placed on banks for funding M&A activity. How big of a part is that going to be? And I guess on top of that, I know you're not private equity folks, but what are you seeing coming down the pipe there?
So that's a very good question. We have no constraints. So we did, again, I can talk about deals that are in the public domain. So when we represented and financed and advised the acquirer when they bought out Wholesome Cement, and the check size written by 3 banks was $2 billion each, right? But we don't have a constraint on financing a acquirer buying listed equity. Unfortunately, the domestic institutions do. I mean, there is a sizable amount of lobbying saying that, make it a level playing field and so on and so forth. Fortunately for us, that hasn't come to fruition yet. So for us, as an institution, acquisition financing is huge. It's a huge part of the private credit play. Again, if you look at the criteria, which is the bespokeness, the higher yields, and the various cap structures when you're actually creating something like that, like I said, we have the know-how and we have the ability to distribute that. So, hopefully we have more buyers of that paper going forward. I hope that is a growth outlook to look forward to. And to answer your question, if that works out well, India becomes a lot more developed in terms of acquisition finance, in our view.
I have a slightly different view here. A lot of the acquisition finance paper, it really ends up with sort of Asian banks and foreign banks, not Indian banks, because they are regulatorily not allowed. And the bank-led syndication market is well and alive in this part of the world, which is Asia. So very few of us end up in these private credit deals. These deals end up in the private credit sort of portfolios. Where we have a role is the stretch senior or the mezz. And I think that's important in a market like India because valuations tend to be super high here, or at least they are at this point in time. There's a lot of dry powder that's been sitting on the sidelines and has to be deployed. And for a buyout which is levered to work, you need appropriate amount of debt in there, which is where I think that we'll all have a play.
IG, you just don't like the price.
All right, unfortunately we have to end it there, but thank you very much.
Thank you. Thank you.
We'll be talking about this for quite a while, I think.
Thank you.
Thanks.
The next conversation is on internationalization, index inclusion, and gift city. In short, all the ways India can attract more foreign investment to its credit market. To discuss that, please welcome to the stage Kaustubh Kulkarni, Senior Country Officer for India and Vice Chair for Asia Pacific at JP Morgan, Supriyo Bhattacharjee, Chief General Manager in the Department of Banking Regulation and Development at IFSCA, Nipa Sheth, Director at Trust Group, and Sanjay Singh, CEO and Head of Territory at BNP Paribas India. Moderating the discussion is Bloomberg's Asia Senior Executive Editor, Sarah Wells.
Thank you, everyone, for joining us here today. Particularly, it's getting rather late on a Friday, so thank you all for being here as well. We've just heard from an expert panel on private credit, and we're turning now to a discussion of the international elements of India's credit markets. In particular, we're going to talk about index inclusion and gift city and the key roles that they are playing. But before we dig into that, I'd like to set the scene with a broad question, which will probably touch on the themes that we've heard from Governor Das and from some of the other panelists. We have shadow banks raising record debt in the onshore bond market. We have dollar bond sales by Indian companies also booming. And on the equities side, we're seeing some would say a historic frenzy in the IPO market. So Sanjay, it must be a great time to be a banker. What is your outlook for 2025? And just adding on to that, are there any pockets of India's markets that you would describe as overheated?
Okay. If I'll try to put in like a little bit more bullet points, so my outlook for 2025, it will be transition led by infrastructure. Mm-hmm. And in that one, if I'll say transition led by infrastructure, that means definitely renewable energy should be the focus. Mm-hmm. And then government, so at the second, infrastructure should be developed for the green hydrogen, mm-hmm. as well as push for the EVs. Mm-hmm. Soft push, hard push both, because as earlier Governor mentioned, infrastructure does not need only physical, there's the IT infrastructure as well. So all these are the need to be set up. So that's main theme for the 2025. If you look at in that one, how is it going to get backup from the overall the economy, or what stage has been set in last 3-4 years? As we heard in the previous session as well, overall economy is pretty good shape. Today, if you look at most of the corporate, their balance sheet is very, very strong. In fact, most of the banks, their bad loans are at 10 years low. These are the things giving a lot of confidence to coming back where how is this growth will be, momentum will continue. As you said, like what all the any particular hot...
overheated, too hot.
Overheated. If you listen to the equity analyst, then equity market...
Should we listen to the equity analyst?
They are intellectual property, so yes, we should listen to them sometime. If you listen to them, then yes, equity market is overheated, expensive. But my point is here, again, I'm not denying that. My point is that it is, if you look at the valuation, it's overheated. But it's a liquidity-driven market today. And liquidity not only driven like across the world, it's mainly local liquidity-driven. If you look at last 1 month, if you start like literally just on a couple minutes more, in the month of September when China started the QE, all of a sudden, so before that they all started entering in the market FIs and China started QE, they exited and chasing there. Last 4 to 6 weeks, we have seen huge sell-off from the FPI, more than $8 billion, which is maybe the highest ever except the COVID time when market hit in 2020. But if you look at the market, is how resilient, how much supported by the local liquidity. So yes, my view, that is a little bit overheated as a theory, but driven by the liquidity.
Mm-hmm, mm-hmm. And local liquidity is obviously the driving force in the domestic corporate bond market as well. Nipa, maybe I'll bring you in here. Your company manages deals for Indian conglomerates, so Tata Sons, Reliance, Adani, among many others this year. And how would you characterize the prospects for the Indian domestic credit market versus fundraising alternatives such as dollar bonds?
I think in the last couple of years, we've seen a lot of change in the domestic market. We saw Governor actually talking about especially the large credit group, and they're actually encouraged or probably directed to raise more than 50% of the incremental credit in the domestic market. There are a few things which we are seeing which is changing. So if you see the bank credit, which is incrementally going to the corporate sector versus the credit bonds which are happening, the ratios have become very encouraging. So I think equally distributed or probably corporate bond markets have grown higher. In last 3-4 years, we've also seen the power sector as well as road sector, the entire funding model changing, which is far more safer, and bond market and the corporate bond market feeling very secure to probably invest there. And as Sanjay also mentioned that infrastructure is a theme, because the cash flows are now looking to be much better, and hence the domestic investors are coming in either in form of infrastructure institution, also InvITs have become a large appetite for these credit side. So it definitely looks like a lot of issuances which were large and did not have the domestic market in the last 3-4 years, which happened in even dollar bonds, probably looking to get refinanced in the rupee bond in current 1 to 2 years. I think there is surely a growing market on the domestic side on this.
Mm-hmm, mm-hmm. And what about that question of foreign investor participation, given we're talking about internationalization? Is that having an impact on the margins, or still too small?
No, I think it also, we've also seen, especially after the inclusion and over the last 2 years, that there is a lot of comfort, even by the foreign institutions, in participating in rupee bond market and not just the dollar market. And you're seeing that trend changing, especially in renewable ESG, where the ESG is also there. So we very clearly see that gap, especially once the government security market is established, I think the comfort to invest in, earlier we saw that participation only in distressed or a very high teen levels. There the comfort has now come into the project level financing as well.
In fact, just to add on that couple point, as you mentioned very rightly, what do you look at the liquidity again in the capital market? What are we expecting from this bond inclusion, 3 of the bond inclusion, roughly $25 to $30 billion. But since it's announced September 2023, already front loading done for almost $18 billion. That's what the liquidity, which is playing the key role nowadays.
And we're lucky to have the Gift City regulator here today. So Priya, given these comments, let's really focus on fundraising. We heard from Governor Das. He's got a list of complaints / wish list from various people. Tell us about the fundraising mechanisms that Gift City can offer as of today, but perhaps more importantly, what more needs to be done to build out that picture?
Right. Thank you, Sarah. Actually, when Gift City was conceptualized, it was conceptualized way back in 2015. But when the unified regulator was formed in 2020, we found that the entire ecosystem was very much a bank-led ecosystem, where the banks were doing most of the financing. And what has happened in the last 4 years is that we have now been able to create a sort of a capital market institutions which are now funding into India. And I'll just give some figures. I'll seek your permission to read out the numbers from my mobile, because I don't want to get it wrong in a Bloomberg forum.
Yes, we do prize accuracy, so that's
okay. Right. So I'll just give you a few figures. Now, as on September 2024, now there are 128 fund management entities registered out of IFSC, with a total of 173 funds or AIFs, and with a targeted corpus of 40.6 billion. And this has happened in the last 4 years. Now, the Nifty derivative contract was shifted from Singapore to IFSC, and the volume there is around $4.8 billion per day. Now, you also have the exchanges. There are 2 exchanges in GIFT IFSC, which is the BSE and NSE have their exchanges. And the monthly turnover was around $102 billion in September, and there is no equity listed as of now, so this is totally debt. And if I go by the total debt listed in IFSC, That stands at around 64.31 billion as of September, with around 13.93 billion of which is sustainable. So I think the focus is now to move to the next level, and one of the things that is going to happen shortly, hopefully by December, we'll have the first direct listing. You would have heard that Government of India has allowed companies, Indian companies as well as foreign companies, but mainly the benefit is for Indian companies to list directly on GIFT City exchanges without having to list in India. And there are talks going on. I can't, of course, divulge the names, but very serious talks are going on. And we are hopeful that a few listings will either be announced or happen by the end of the year. So the focus from bank-led model to debt-led model is underway.
That's interesting. On that direct listing piece, is that Indian companies or foreign companies?
They are Indian companies. There are foreign companies too, but I think our focus is mainly to encourage Indian companies because that's where the benefit is.
And Kostab, I want to turn to you. Obviously, JP Morgan is represented in GIFT City. The question that I just asked Supriya around the wish list of the participants there, maybe I should have actually asked that to you. So what's top of your list? What can be done to make GIFT City more attractive both to banks but also ultimately to clients?
Yeah, so I think, Sarah, on that, I'll just put it factually without going into details. Last year, for JP Morgan, we were doing effectively only single product, which is NDF, and then I think we had a sandbox for our blockchain. So there were two primary initiatives for JP Morgan with GIFT City. If I reflect on our 2024 engagement, and we're just doing our recap last week, there are 18 different agenda items that we are discussing internally and with GIFT City, and the dialogue has been effectively like a partner, which means we think through what is it that we would like to do, which are the financing alternatives. So of those 18, 5 are different financing instruments that we would like to, I think, offer to our clients through GIFT City as a mechanism. One is on the equity side, 2 more on, I think, both the exchanges, bullion. So I think for us, the agenda has become so broad, and we are spending all the time in having the plumbing in place, and the actual benefit or revenue opportunity and therefore contribution will come in 2025. So we think we have made substantial progress for JP Morgan. We ourselves did not anticipate all of these things are possible, but thanks to the dialogue, I think we are where we are right now. So we are very excited about what more we can do.
And it would be wrong to have JP Morgan on this panel without asking you a specific index inclusion question. We've heard both actually on this panel and on prior ones, about the importance of this milestone for India. But I wanted to ask, this is a major step in opening up, but we've also seen the RBI blocking foreigners from buying some newly issued bonds. So I wanted to get a sense check from you. How committed are authorities to the opening up process?
I think our sense, and this has been, I think, at least from a JP Morgan index team perspective, this has been an important topic for the last 4 or 5 years. Finally, I think the index team announced it last September. We became live in June. And through the dialogue, I think what we have understood is it is effectively a one-way conversation, which is you always move forward. Yes, there are issues that come in terms of, I think, what we want to address. But by and large, the engagement for the index team with the regulator, in this case RBI, has been let's find a way forward so that we can make it happen. So that's point number 1. Point number 2, I think it's also not lost on both our government and the regulator that having more high-quality institutional investors participate in an important market, which is the G6, is generally going to benefit because these investors are looking for term exposure, generally not coming with a trading mindset, and you are therefore allowing a very different pool of liquidity come into the market. And do remember, this is a very liquid market. So the amount of GSEC trading that we have, while we focus on the cash equities turnover, the GSEC turnover that is there in the country is also very substantial. And this is still a very, very tiny portion of the entire GSEC exposure that the foreign investors will be owning. The trickle-down effect of that, of course, is one, it definitely has contributed to the 10-year pricing and therefore the 10-year yield curve. And that benefits all borrowers, not just, of course, the government, but it benefits all borrowers in terms of the impact on the overall interest rate in the country. But more importantly, because of the exposure for these investors to different pools of capital that these investors have, it also then sets up for the next wave of very highly rated Indian companies to start talking to them for their own capital market. And in general, that will therefore help further accelerate development of rupee debt capital market solutions to a broad set of institutional investors, which candidly, I think if you look at the earlier 2 sessions as well, we still would like to do a lot more before we can develop that market. So I think to me, I think it's just going to be helpful.
Nipa, can I turn that over to you? What would be the one most significant thing that regulators could do to deepen the participation of global investors in the rupee bond market?
I would just, make a couple of other points as well, that, the kind of stepping stone or kind of things which regulators have done over the last 3 years are pretty commendable. So while we are looking at the inclusion and the foreign capital coming into the domestic market, we've also seen simultaneously a very vibrant domestic market where we've put 4 or 5 institutions on the infrastructure side who are there to probably look at infrastructure bond. Sebi's also, laid pretty good guidelines in terms of how retail participation should come. To counter a liquidity in the market, we've got a repo institution which is coming. Which is, especially after the inclusion, any markets which anybody would invest would look at a diversification of a lot of investors. And we have seen that slowly and a steady piece of that happening. And I think that would make a big difference in terms of how the participation. In the earlier panel, you also saw that good amount of AIF also have come in terms of investments. So we are seeing a diversified source of money which is coming in to ensure that there is a good participation by all kind of players which will come in. Also, with the kind of flow which is coming into the inclusion, the space with the domestic institution players also get very opened up in terms of buying the credit market, which is beyond just the rates. So I feel the stage has been set to move a credit beyond the banking sector, which is probably need of the hour right now.
And Supriya, I want to pick up on those comments from Nipa about the strength and the development in the domestic bond market, and also something you said earlier this week when we spoke. We don't hear much about the arguments for India issuing a sovereign dollar bond these days. Why is that?
I think the answer lies in what she essentially said, that people are refinancing into rupees. I think if you can borrow in your own currency, theoretically you shouldn't need to borrow in any other currency. The normal argument for borrowing or issuing sovereign debt in foreign currency and US dollars was that our companies were borrowing in foreign currency. And so for pricing that, you needed the sovereign curve out of which the other entities could price it out of. So I think the problem is solved itself to a certain extent. We had a close shave where we almost did that. And but I think it's a sign of the strength that you are able to borrow in your own currency and you're able to do it consistently, and in a way it's path towards internationalization of rupee, because internationalization rupee is not only the rupee account being opened outside India. I think that's the last step. The first step is people are willing to hold rupee assets. So that's the first and most important step. The others are all mechanics. So I think I think if you talk about rupee internationalization, this is, I think, a core part of rupee internationalization, that people are willing to hold assets in Indian rupees, and I think that's the big thing here.
And Sanjay, let's get back to Gift City. BNP Paribas opened a branch in July. How many staff do you have on the ground, and what kind of business are you transacting through there?
So, as you rightly said, we are the youngest over there amongst our all banking colleagues, and we just opened our branch on 8th of July 2024, and we have started very limited staff, I think 6 or 7 only as of now. But good news is that it's just like 3 months old we are, and we have done 5 big deals. So it's like
what kind of deals?
So basically we did the 3 ECBs and 2 NDFs. That's these 5 deals, which is showing again how much things are already waiting in the system. They are just looking for the means. And as Kaustubh already explained earlier, the product and all, definitely in addition to the ECB, NDF, there's of course TRS, which is going to be very popular over there. Supply chain is going to be very popular over there. So these are the things clients are definitely looking for to look for the Gift City. But we are also seeing what other things Gift can help, like kind of like, again, the transition where they can help for the sustainable finance as well. That we are seeing another piece. Okay, so we are the French bank, we do a lot of push for the sustainability, and we are seeing GIFT can be the very important means to help to the client to move towards the sustainable finance. So that's more or less these kind of things.
Supriyo, we've previously been told that a priority for GIFT City is supporting acquisition financing. What's happening in that space right now?
Yeah, so I mean, the first point, I think Mr. Baliga mentioned in the previous session that acquisition financing is not permitted under Indian law. So actually, I mean, for the people to know, the Banking Regulation Act applies to IFSC just as it applies to India, the rest of India. But we got a carve-out. There is a procedure by which carve-outs can be given from Indian laws, central laws, by the government. And the government of India actually understood the requirement. So technically, foreign banks in IFSC today can provide finance for acquisition finance. We have seen a few deals coming. It's episodic because you need to have a company acquiring another company. So it can't happen on a normal basis. But the legislative part has happened. And Indian banks, of course, are not allowed because RBI, RBI being the home regulator, its guidelines apply. But for foreign banks or even non-banks, you can actually fund acquisitions out of IFSC, out of your own balance sheet, within the Indian law. So I think small deals have happened. We hope the next round, when acquisitions happens again, you will get financing from onshore, that's from India, rather than having to go to Singapore or Hong Kong.
Great. And Kostab, I wanted to turn to you to discuss actually some comments made by Sanjay earlier and on one of our earlier panels, talking about the risks that can come with internationalization. It's not just a domestic story anymore. You are more exposed to global tailwinds and also headwinds. How are you thinking about that risk and what it means for your strategy here?
I think, yes, internationalization for the economy means that the expectations that, but in my view, any institutional capital will have the same expectations on parting with that capital, which is high quality governance, predictable regulatory framework. And to me, I think these are two fundamental. And third, equally important, is the quality of management team and quality of businesses that effectively they're either underwriting or providing capital for. To me, I think while the first two, thanks to both RBI and Sebi, we have made so much more progress in terms of the regulatory framework through which companies are disclosing information on a quarterly basis. The excitement that we see from international capital is about the quality of management teams, the hunger and passion that we are seeing from them, type of businesses that they are creating, so much test bed for India as a very large domestic market, basis which you can create some fascinating technology-led, low-cost, high-capability business models which can scale up in a short period of time. And what we are seeing in the country is businesses which are being created in 8, 10, 12 years, which is very, very short period of time that is happening. And to me, that is great exciting from institutional international capital. So to me, I think having the building blocks of all of it necessarily means India has probably become the best market to raise equity capital. Not just because the valuations are probably expensive or not, that is in the eyes of the person or the investor paying the money. It's also because of the type and nature of companies who are coming in. And guess the money is only going to companies where people believe these companies are going to survive for next 20, 30, 40 years. Whenever you take companies where you don't know, the capital is not willing to flow. So I think to me, all of this is to be looked at in a combination of how India has progressed so much in terms of institutional ownership of capital in the country, whether it is infrastructure, whether it is all of these new companies, startup companies. New India is largely owned by many, many investors and not just by 1 or 2 or 3 or 4 conglomerates or 1 or 3 or 4 companies. To me, that is very exciting.
I'd just like to add a couple of points. Kastub said very clearly, but just to add it, when we're going through this internalization and what can be the risk in addition to what Kastub mentioned, we have seen multiple times whenever any global crisis happens, that time, of course, you see the foreign self flow. are we ready if something global crisis come tomorrow and when foreigners start selling the bond market, are we ready to do any mitigation for that? So yes, that's one other risk. If I look at today, my view, yes, we are, I will not say 100% foolproof, but we're very much ready. There's the two main reasons. One, as we all know, that we are almost all-time high for the Forex reserve. But second and most important, today our Indian insurance companies are too big in the size. And they love to buy long-dated bonds and all these. So whenever such situation arrive, I'm pretty confident they will do the counter to fulfill the whatever needs to be there over there to mitigate these kind of the risks.
Well, I think the room hopes that you're right. We are very low on time, but I want to finish with a lightning round question. If we were sitting here in 3 years' time, the same panel, and I hope that we get to do that. That would be, I guess, the fourth Bloomberg India Credit Forum, and talking about internationalization. What do you think would have been the most significant change? So, give me one sentence.
Ease of business much better.
Okay, great. Nipa, how about you?
I think steadiness of the economy over the last, when as the government said that geopolitical and geographical risk, I think India has been very steady here.
I think it's the ease of access. I think the governor hinted at that they are doing that. I think that would be the fundamental driver.
My view will be 25-30% larger with very little risks on the horizon.
Excellent. Thank you so much.
Thank you.
Our next conversation is on regulating for growth. Simply put, that means knowing how to throw a great party, but also knowing when to stop the music. To discuss that, please welcome to the stage Ananth Narayan, whole-time member at the Securities and Exchange Board of India, Sebi.
Take that one.
Good evening, and Anand, thank you very much for being here.
Thanks for having me.
You've heard the context, so I'll jump off into the deep end. What can be done now, after years of incremental improvement, to deepen India's corporate bond market? What would you say are SEBI's top priorities?
Right. Few areas that we are working on pretty hard. First is on the corporate bond market itself. We've finally got the limited purpose clearing corporation up and running. We're seeing about 1,000 crores of repo transactions happening every day. That's still small. We still have ways to go. But it's showing good progress. And I think one of the long-standing requirements of the market has always been that there should be liquidity available for traders and for market makers to be able to access. We think LPCC has a good future, and a few more things, including RBI's recognition of LPCC as a qualified clearing corporation, will help deepen this market even further. So that's a good step that's already in motion.
What will bring more foreign investors to this market, given that there's still a very, very small element of it?
On that, I guess the fact that you had the index inclusion in the sovereign bond space should spin off into more.
Okay.
But I think the reality is the domestic market has to deepen first before we actually think about using the foreign route. The second thing that, besides LPCC, we have the backstop facility in place now,
Sure.
which was a requirement from the earlier crisis. That's in place now and that's up and running. We're also doing things like, for instance, we're the first regulator really which has allowed our regulated entities to sell protection via CDSs. First in AIFs, the alternate investment funds, and now in mutual funds as well. So it's a whole bunch of things that we're trying to do to help build the ecosystem.
Anything new?
Finally,
we don't want to make headlines tonight.
I'm going to keep this really boring. I'm sorry. But on the alternate investment space as well, on the AIF space, about 1/4 of the investments that we are seeing coming through the AIF space is towards credit. Again, I think there's a lot that we can do there to try and see if we can foster more of the private credit space. It's not directly into the corporate bond market, but all of it counts. Overall, I think across corporate bonds, InvITs, REITs, munis, these remain clearly focus areas for us.
Yeah, actually, I should have said this in the introduction. It's very interesting if we are in an era of this big shift away from bank credit to non-bank credit, and then, areas like AIFs, even PMS investments, the newer products that you introduced, I think the new investment strategies products, the corporate bond market, of course, effectively you will become a far more important regulator at SEBI, over time, when it comes to credit, right?
Yeah. So I think the way we have to see this is, look, we are channeling a whole bunch of savings into investments via the capital markets. At the moment, the flavor appears to be equity markets. So the last fiscal year, FY24, we had about 3.6 trillion rupees, 3.6 lakh crores coming in via individuals, mutual funds, domestic institutional investors, even foreign portfolio investors into the equity markets. I think that's been the trend so far. But as things stabilize, I think you'll see people starting to do more of asset allocation, more of diversification, and I think it's inevitable that debt markets will pick up as well in terms of investor interest. So our effort is let's try and keep the foundation and the guardrails strong in both equity markets as well as in debt markets and everything that goes along with it, including hybrids. And then the investors will sort of come there and settle down as to where they want.
Sure. But I'll ask you for specifics, right? Like we've spent the evening discussing, some of the risks in the AIF space, the private credit space. The numbers are now, becoming significant, about 12 trillion rupees in the AIF space, 10 trillion in the PMS space. Where do you see risks? You've acted against evergreening of loans. Alongside RBI, you've acted on concerns around valuation, you've acted on concerns of preferred rights to some investors in AIFs. Where are the new risks emerging?
Look, it's an ongoing journey, and you're right, we've seen fantastic progress in AIF specifically over the last 5 years. By the way, the September data suggests we are now 12.5 trillion rupees worth of commitments and about 4.5 trillion rupees worth of investments.
Right.
And it's grown, both have grown at roughly a compounded annual growth rate of about 30% over the last 5 years. So it's been very, very steady growth. I think from a regulatory perspective, and you've heard me say this before, Menka, we're looking at this in two ways. One is we are seeing instances where AIFs have been in the past, particularly in the past, been misused as structures to circumvent existing regulations. You mentioned, evergreening. There have been other issues as well around FEMA, about IBC and so on and so forth. At the same time, we're very clear that while we want to stop that, we can't come in the way of good business. Our regulatory response has to be very calibrated and very focused. Stop the bad things, don't come in the way of good things, and if possible, actually try and encourage good things. So if you see the response we've taken in the last few months, we've actually come out with a bold regulation which says, do not use AIFs as a structure to circumvent. Now that sounds like a very scary regulation, very broad-based regulation, but we've converted that to actual standards which the industry has set on what are the specific do's and don'ts that they have to adhere to ensure that they are not circumventing evergreening regulations or FEMA regulations or IBC regulations. That gives us the space to actually then liberalize a lot more. So if you saw the last board meeting, we've actually allowed tranching of certain amount of units in AIFs,
Sure.
which was an issue that we had because of evergreening, etc. We've allowed parts of that. Previously, we've allowed pledging of investee company equity by AIFs in order to raise funds at the investee company level. All of these are steps to liberalize while at the same time ensuring
But
they're not
that's
being
all backward looking. I'm trying to look ahead and say, where do you see the new risks?
Look, I think that this journey will continue in terms of
At the moment, do
ensuring
you
structural.
see spots of weakness in the private credit market, whether it's through alternate investment funds or even through PMS investments? How do you see that evolve?
It's an ongoing journey where all of it, whether it's investor protection, whether it's structural risks, have to be taken into account. In the AIF space, of course, the level of investor protection required can be lower, and that we are cognizant of that. Of course, we still have to manage that bit. What has been dominant over the last the couple of years that I've been in Sebi has been the structural element, the fact that some structures are being used to circumvent existing regulations. And again, our focus has been detection, making sure that there is prevention in place, and that whatever we do in terms of detection and prevention does not stop legitimate business. That's been our effort.
Okay, so through the evening we've discussed the corporate bond market, the private credit market, whether it's through alternate funds or through other routes. We've also discussed foreign investor participation. That is an area that comes directly under you, and it's been an area of lots of activity over the last 2 years, most specifically your effort to get them to disclose their beneficial ownership. How many funds have exited India because of the additional compliance paperwork that has come into what is a very necessary rule? I'm not arguing against it, but how many of them have chosen to say, hey, this is too tedious, we're out?
I think the important number to focus on is, one, at this point in time, we are in a state where we can say that there is no FPI which has more than 50% concentration in a particular corporate group, where either we are not completely comfortable that they are a public retail fund or a sovereign wealth fund and therefore we don't really have any issues, or where we've not got 100% details about every single economic interest holder in that particular entity. So, and by the way, a lot of FPIs actually have disclosed very, very granular details about the economic interest holders in their entity. So that, I think, is a number to focus on. In terms of the specific question that you're asking, look, again, the number to focus on, if you ask me, is over the last, since April of 2023, when we had these discussions ongoing, we've seen net $27 billion of inflows come into our equity markets through FPIs.
We've also seen outflows, Ananth. I apologize for interrupting you.
I'm talking about net numbers. Now, I can also tell you that I think there's a large understanding about why we have taken the steps that we've taken.
Sure.
And the fact that these steps are an important step to ensure that there is confidence in the markets, and there is faith that, there are checks and balances to ensure that there is no circumvention or breach of any regulations.
Again, I'm not questioning the regulation.
Now,
I'm just curious to know how many have exited India. And fine, the regulator may say, but these are our rules, and if you can't comply with this, you're free to go. I'm just curious to know what the response has been. That's all.
I think the response has been overwhelmingly positive. As I said, there have been a lot of actual FPIs who have actually disclosed to us. If you want granular details, what we will try and do is maybe come out with a white paper on the entire journey. Because giving numbers in bits and pieces, look, we have disclosures which are made as a matter of course. How much inflows come in, how much net outflows go in. By the way, attributing motives to every inflow and outflow, I can tell you, is not an easy job.
Okay.
You'll have to do a lot of speculation there. So the point is, we know the aggregate numbers, what they look like. If you want a white paper, maybe our research team can look at it. But I think the important thing to note is this has gone off reasonably smoothly, the implementation of the August 2023 circular. You've not heard too much of noise about it. In fact, we've seen net inflows come through, notwithstanding the last few days. It's been very large inflows that have come through. I think the confidence in the Indian market remains pretty large, and we will ensure that it remains that way.
Okay. We've talked about KYC or Know Your Customer norms through the afternoon. The governor said, but that's, SEBI's mandate. What have you been able to do to simplify that process, to bring more foreign investors here? What have you identified as things that yet need fixing, which the regulator is on the job for?
A few things that are already in progress. You've seen consultation papers coming out from us. The last one, I think, which came out last week, we have a common application form for foreign portfolio investors to come into the country, which is across RBI, which is across SEBI and across CBDT, because you also need a tax PAN number when you come into the country. It's a common platform. We've come out with a consultative paper which suggests that for certain kinds of FPIs, which are pretty frequent, we can reduce the number of fields in that particular form by up to 45%. Okay. Now, what we're trying to do, Menka, is actually take a very risk-based approach on what can we do to make life easier. Now, I can talk about a couple of more things that we're looking to do. One is for investors that are only investing in sovereign government bonds as a result of, the index inclusion and so on and so forth. We're going to reduce a lot of requirements from the SEBI side. We're in fact going to rely entirely on what RBI asks for in terms of KYC, and make sure there's not a single piece of information more that's required from a SEBI side. Of course, we'll have checks and balances to ensure that there are no equities that they hold and so on and so forth. The third thing, which I think is very exciting personally for me, the other circular that you were grilling me about, the August 24th circular of last year.
The beneficial ownership.
The beneficial owner one. If you remember, what we did was we spent a lot of time on identifying foreign portfolio investors where we really don't need to insist on granular exposure to the last cent, even if there was concentration norms which were being fulfilled, for instance. For instance, if you're a sovereign wealth fund, if you're a government-owned entity, if you're a public retail fund, if you're an insurance company, regulated insurance company investing your own funds, or a pension fund, or a listed entity in certain exchanges. Now, what we realize is there's a whole host of these entities where there's a lot of comfort and trust, verifiable trust around their existence. Now, what we're trying to do going forward is see that if for these particular set of investors, can we really reduce the requirements, both for registration as well as ongoing compliances? For instance, can we do with just swift confirmations of a lot of paper, which otherwise comes as wet signatures going up and down and creating, bottlenecks. So there are plenty of things that I think can be done on that score. Okay. That again will be, we're a consultative regulator. We'll come out with a consultation paper, hopefully soon. For these, and by the way, they account for a significant portion of the assets under management that are already in the country. These are truly trusted and verifiable FPI, where I think we can do a lot of work. Again, what I would really like is, especially from your viewers and your subscribers, if there are specific suggestions on what we could do to cut down on paperwork, on red tape, very, very happy to take those on board, particularly for these kind of investors.
All right. I want to do a couple of very quick, non-credit market questions, because if we have the regulator, it can hardly waste that opportunity. In the last board meeting, you all suggested that instantaneous settlement was out of the window. You were only going to do same-day settlement. Why? I mean, have you closed the door on instantaneous settlement?
For now, we've closed the door.
Altogether?
For now, we've closed. For now, I can't speak for my successor or her successor. But the broader objective really is to try and ensure that we de-risk the system and we reduce any level of opaque charges which are there in the ecosystem amongst the intermediaries. So one of the issues that we've found is that there's a fair amount of client investor money that stays with intermediaries, either with brokers or with custodians, through the course of the trading and settlement process. Now, what we are trying to do is to try and keep investor money with the banking system, which is a regulated ecosystem, rather than have them with our intermediaries, which are not really banks. Now, this is the way markets have always operated for many, many years. What we find is that things like using the UPI block mechanism to be able to trade in secondary markets, or the optional T+0 mechanism, helps in that process of ensuring that there is less float sitting with the intermediary ecosystem, thereby reducing opaque costs and reducing risks as well. Now, this is, one step towards that, as I mentioned, is T+0. It's not really taken off despite the beta version that we've launched. Of course, we've now have the board approval to expand that to 500 securities and do it across a lot more brokers. But one of the issues that we got as a feedback from the ecosystem was, if you're going to say that you're going to eventually move from T+0 into instant settlement over the next few months or even quarters, why would we want to invest in T+0 at all? It's after all a stopgap kind of a mechanism. So, and we also recognize that the actual settlement mechanism in instant settlement is very different from what we have currently. T+1 is effectively being crunched to give us T+0. It's not a fundamental shift in the nature of the trading or settlement. But instant settlement would be dramatically different because every single trade will have to be gross settled. And that's a totally different technology architecture. So both in terms of the investments required for instant settlement, and therefore the changes that we would subject the ecosystem to, and in terms of what it does to T+0, if nobody's going to be interested in T+0, optional T+0, because they're waiting for instant settlement, we thought it's not a great idea to talk about instant settlement. So it's completely off the table for now. We're going to focus entirely on this optional T+0 and see how that goes.
Okay, you've just put into effect, in a phased fashion, a set of new restrictions when it comes to trading in the F&O market. I'm just simplifying it for a global audience and not getting into too much detail. Is there more to come in that area? Because to me, it seems like SEBI there is this war on speculators going on at SEBI, whether it's in the cash market where you've now underscored twice the kind of losses that day traders are making. And in the F&O market, you've not just signaled the losses, but you've taken severe actions to curtail their participation in the market.
So for the record, Minka, first, we like derivative markets. I'm not saying we're not against. I'm saying we like derivative markets. We are definitely not against speculation or trading or market making. We know these are essential for the market in order to have price discovery, in order to have depth in markets, in order to have people have avenues for hedging their risks. So it's absolutely essential. So we have no doubts in our mind that these are essential components of the ecosystem. What we are trying to do is twofold. One is we are focusing very, very sharply on areas where we believe that the speculation level has gone to a situation where there is serious threat to investor protection as well as to systemic stability.
So you're saying the situation at this point, actually is a threat to systemic stability? Because in previous commentary, SEBI has not said that.
What we are saying is that the level of activity that we saw on expiry day index options, which was practically a 0 day to expiry trading of index options, very specifically was an area where we didn't see too much of, positive things going towards capital formation. Instead, we saw a lot of risk to investor protection and systemic risks building up as well, because actually the open interest in these kind of contracts was building up right up to 5 minutes before expiry. So what we are doing is a very, very targeted attempt to try and ensure that trading in index options on expiry day is controlled. So out of the 6 steps that we've announced, 4 of them are clearly focused on this. So it's a very focused approach. Now you have to juxtapose this with our new, entry and exit criteria that we've announced for single stop options and futures, which actually expands the pie of number of stocks which are available for F&O. There are plenty of other steps where we are taking to actually increase the depth in the derivative markets in consonance with the depth in the cash markets as well. So it's a very focused approach. We are not against derivative markets. We are not against speculation. We are focusing on areas where we think that the pendulum has swung too much into a area causing both systemic risks as well as risks to investor protection.
But
The
then
second
that is
area...
This is the first time I've heard you say systemic risk when it comes to this. So far it was losses, it was a waste of money, if I may say so, because it's not going towards productive, requirements. This is the first time I'm hearing you say systemic risk.
I would encourage you to read our consultation
I've read
paper
it several times. You have not said systemic risk
and the speech I gave earlier. By the way, in both the cases, we've talked about systemic risk. The fact that you have open interest which goes up right up to the expiry time, at a time when we don't monitor individual level risks or individual level OI on real-time basis is a risk. The second part, you talked about intraday cash trading and numbers that we give out. Look, in fact, the first pillar in our preamble of the SEBI Act is investor protection and investor awareness. So you've got to our job is to make sure investors are aware, right? So when we talk about 93% losses over the last 3 years on F&O trading, or when we talk about 70% losses for intraday trading, these are a part of our investor awareness and education programs. Sure. That doesn't mean everything is going to translate into regulatory action as well. If you recollect, our first report came out in January 2023 on the F&O part, right? Now, it's taken us till now to actually talk about taking steps to control a very, very focused and specific part of the F&O markets. So we're very thoughtful about the way we do things. The Hippocratic oath about first do no harm is right there on my wall in my office, right? So we know that as a regulator, we've got to be very, very measured in the way we act, and we are very thoughtful and consultative in the way we act. So
more F&O restrictions coming?
Now, the way we're going to do is, as you know, most of the steps that we've announced come into effect from November 20th onwards.
In a phased fashion.
In a phased fashion. A lot of them start to take effect from November 20th, and others January, February, I think there are other dates, April as well. But we will obviously watch how the markets pan out after that. We will see what happens to the volumes. We'll see what happens to the trading ecosystem. And then again, in a consultative fashion, depending on what the landscape looks like, we will have discussions, open discussions. Nothing that we do is behind closed doors. It's all an open discussion.
But you're saying you are considering
We always look at data, we always look at the context, and we will always consider actions in a consultative fashion.
Okay. One of the things you pointed out, two last questions. One of the things you pointed out in a recent speech was the gap in supply and demand of paper in the equity market. We've seen a flood of IPOs. You've seen that gap narrow. I mean, given the response to, I don't want to name an IPO because then you won't answer my question, but given the response to one large recent IPO, do you feel that gap is narrowing? And that's a healthy thing.
So you're right. I have spoken about this gap between supply and demand. Again, look, it's part of our effort to ensure that people are aware of the risks in the market. This is an ecosystem where we've got to get financial inclusion, where we get savers to become investors and contribute towards, risk capital, so that issuers can come raise risk capital and create businesses, and that cycle becomes a virtuous cycle. That's absolutely our goal. At the same time, we need people to come in completely aware of the risks, so that this is a sustained cycle rather than that one that goes in spurts. Now, a couple of things. Last year, FY24 was actually a dream year in many ways for Indian capital markets, Indian equity markets. So benchmark indices, grew at 28% during that fiscal year, and the actual realized volatility of that index was 10%. So this is the best of both worlds: low volatility, very high returns. Now the problem with things like that, and there is a downside to it, is it breeds complacency.
Yeah.
So the last year was a year, I mentioned to you that 3.6 trillion rupees was the actual inflow that came into the markets from individuals, domestic institutions, as well as foreign institutions. The actual supply was just 1.95 trillion rupees. So you had a mismatch of about 1.65 trillion rupees. Now, this year, by the way, if you look at the first few months until, I think, August or maybe even September, the actual inflows into domestic mutual funds from retail investors into risk-oriented fund schemes already exceeds the number which came in the whole of last year, right? Now, of course, supply has gone up, but demand has been pretty high as well. I think these things equalize over time. These things, you can never have a perfect situation where supply of fresh paper is exactly equal to the demand that's coming in from all investors. In a sense, at a personal level, and this is not a SEBI view, at a personal level, I'm not really upset about the current volatility, if you can call it volatility. Because in a way, it reinforces the fact that this is capital markets do come with risks. It's important that particularly retail investors be aware and be acutely aware of the fact that this is not a one-way street where you only have good news and not really the volatility as well. Particularly since a big chunk of the people entering our capital markets now are young people who've really not seen cycles. Yeah. So it's not bad to have volatility. In a way, for a sustained growth in capital markets, a spot of volatility is not a bad thing at all.
Okay, final question, because really it's going to be otherwise a long, I have many, but it'll be a long evening for everyone. It's been, what, 2 years since you joined SEBI and you moved over from that side of the room to this side of the room. And it's been a tumultuous 2 years at SEBI. What's the shift been like?
It's been brilliant, Menka. I have only the deepest sense of gratitude to Providence for giving me the opportunity. Couple of things, First is, I've been an industry person and then an academic for several years of my life. I've always felt through my career that, all stakeholders sometimes tend to talk past each other than talk to each other. So, industry, financial services, investors, regulators, policymakers, academics, sometimes you're not listening to each other. And wearing these different shoes, in a small way, I'm trying to connect the dots and make sure that we, understand each other's perspectives better, because I think that's important to see the capital market ecosystem grow. The second part, really, which has been a very positive revelation for me, it's been a remarkable experience within SEBI. The people there are fantastic, an extremely professional, competent, knowledgeable set of people with tremendous amount of institutional knowledge and history. It's a very professional organization, and both the board as well as the folks in SEBI have actually allowed me to deliver my job to the best of my ability and with a clean conscience. Now, whether it's on policy matters, whether it's on enforcement, whether it's on me as a quasi-judicial authority or administrative matters, what more can I ask for than that I can do my job professionally in a professional organization with a clean conscience?
No Hindenburg report. That's what more you could have asked for. Ananth, thank you so much for joining us. No, finish, please do.
No, I'm waiting to finish my role as a regulator, and then, I'll probably write a few things. But I can tell you this. What I'm saying now will be something which I'll say even after I move out of SEBI, when my stint is over. I think there's a lot of reason to trust the ecosystem and trust SEBI. It's a very professional organization where we work with a lot of checks and balances. And as I said, as an outsider coming in, I've had the full support to do my job professionally and with a clean conscience.
You won't give the chairperson's job a shot?
We'll talk about that later. That's not on my radar at all at this point in time. As the governor said, I'm more worried about what's the files on my table right now than the future.
All right. Thank you, Ananth, so much
Thanks
for answering all the questions with candor. And I must also thank the audience. So first, thank you. Okay, so with that, thank you to all our wonderful panelists from RBI and SEBI and all of you credit market experts sitting here. Thank you for being here this evening. I must remind you again, please scan the QR code. There is now also a survey form there for you to share feedback with us so that next year when we come back with the India Credit Forum, it can be bigger and better. And once you've done all of that, please join us for cocktails and dinner. Thank you very much.